Good evening and welcome to tonight's Premium Account Live Market Update webinar. The information is prepared for general information of traders, and the information does not take into consideration the specific needs, investment objectives or financial situation of any person. Any individual reading or listening should discuss with their financial planner or advisor the merits of any recommendation offer presented in this material for their own specific circumstances, and realise that not all investments are appropriate for every individual. Presenter tonight, myself, Leon Hine, current Managing Director of Global Equity Management and Investment Manager of the Investor Signals Unit Trust. The format for tonight's presentation: we look at the global macro outlook driving equity markets. We roll through the ASX top 50 with a specific sort of outlook around the 2013 and 2014 PE and dividend forecast. We look at our preferred buy and sell transactions in the market at the moment, price targets and valuations, and we conclude with a short-term Australian market outlook. The services that we provide are up on screen there, and if you'd like to know more about those, please contact either myself or Christine, info@investorsignals.com. Moving straight into a graph of the US market. So as we push through the March quarter earnings, what we're seeing is a majority of S&P 500 companies slightly outperform market consensus, and that keeps us on track to deliver something in the range of around sort of 105 of US earnings on an annualized basis, and that underpins a sort of 14 times multiple that the S&P 500 is trading on at present. Keep in mind that analysts have been forecasting roughly 10% EPS growth in the 12 months ahead. What we're seeing at a macro level in the numbers coming out of the US is revenue growth is reasonably slow relative to where I think analysts would like to see, but certainly cost control has been very strong. What we're starting to see come through some of the results is the higher US dollar impacting earnings a little, and that was something that I'd sort of flagged going back a number of months. But essentially, you know, the overriding factor is that global yields in the bond market are so low that it's pushing investors into equities, and especially the more stable sort of dividend-paying stocks, and that's underpinning the market at present. We're seeing sort of continued central bank liquidity coming in from Japan, the Federal Reserve, and then increasingly in Europe, and I'll get to that in a moment. Consumer confidence numbers in the US are holding up quite well. Manufacturing data in China in April was marginally slower than March, but generally, you know, we're not seeing any significant risks emerge in Asia or out of China that are not already sort of priced into equity valuations at present. So our base case is that equity markets largely move sideways on valuations grounds from where we are at the moment. We think at the margin, obviously, any additional either cutting interest rates from the Eurozone or additional monetary stimulus coming from the ECB will continue to sort of put a floor under the market. But valuations are getting fairly expensive if it's just the yield argument that holds things from these levels, given that we're not seeing sort of that top-line revenue growth there. And that in some ways a function of the slightly slower global GDP number that we're seeing that is missing on the downside a little from where analysts had expectations, and that's largely a factor where Europe is weighing on the rest of the world at present. So from a macro view, equity markets, I think we still need to be long equities in investment portfolios with a skew towards dividend-paying stocks, and we kind of maintain our view that sort of the tight covered call strategy over your defensive names from a risk-reward standpoint is the best way to allocate in portfolios, and I'll get to that more as we go through the top 50 stocks. Moving on from the US market, just a quick look at the currency and gold. So this is a picture of the euro dollar. We're seeing the US dollar index pull back a little bit from its highs, and we're seeing the euro find support. Interesting enough that this is coming in the face of what's likely to be a 50 basis point cut in the ECB rate and the prospect of Mario Draghi from the ECB announcing further stimulus measures. I think the pressure's really building in the Eurozone for them to look past some of the austerity measures and have a looser monetary policy like what the Federal Reserve has done. So there could be a further wall of liquidity in the next 12 to 18 months that comes into equity markets from Europe, which would continue to kind of underpin the current status quo. A quick look at gold. So obviously there's been a lot of concern in the market about the gold bubble bursting. My own view on this is that I think gold tracks the M1 money supply, which is the amount of US dollars in circulation. I think we're seeing a strong correction in the gold market, but I don't see it falling away back down to 700 or 800 an ounce. I think somewhere around this sort of 1400 to back to around 1650 an ounce I think will be where gold consolidates, and again I think we'll get into a period where it tracks sideways, but ultimately the fact that the US is not going to stop expanding their balance sheet anytime soon, that gold as a minimum should be well supported in a sideways consolidation. And I think sort of some of the overreaction that's filtered through into the gold stocks presents an opportunity, but more specifically in the context of the stocks that we cover, Newcrest Mining on sort of a 12 to 24 month outlook. Moving into the local market, so trading, pushing up to around 15 times earnings at the moment. The XJO is getting expensive. We're compressing down to about a 3.9% yield on the market, which is starting to really, I guess, sort of push up against the top end of that boundary from our perspective in the way that we view equities from a valuation standpoint. Traditionally, from May through to September has been a weak period for equities. However, are we pricing in an excessive sell-off and a pullback to lower levels where the market falls 10%? Probably not, and I really think that's a combination of central banks providing backstop and obviously the low global bond yields and the need for investors to seek yield through the defensive names that will ultimately hold the market up. Put that in the context of the fact that the resources have already sold off substantially, and the index is at these levels. The prospect of the index itself pulling back substantially, I think, is limited, given that we don't see too much further downside in the resource names. Okay, so at a macro level, that sort of summarizes our view. Let's move straight into the top 50 stocks and have a look at our preferred buy and sell allocations within these names. So AGK is now pulling back to somewhere where we're, again, take a look at it from a long or from a buying opportunity standpoint, around 1575, 1550. We're buyers of it. I think coming into the August-September dividend, AGK can trade back up to around 1650. We're looking for about 10% EPS growth over the next 12 months out of AGK. I have it on a current yield of around just over 4%. If we look at the earnings growth out to 2014, it's yielding around 4.5%. Through selling that covered call up at around 1650, we're getting a cash flow out of AGK of around 10%, and I see the downside risk to it in the event of a market sell-off as reasonably limited, down to around sort of that around that sort of $15.50 to $15 range. Moving on from AGK, Asiano, so obviously this is a name where management had been guiding towards 10 to 15% EPS growth. We've seen some of the volumes well, we'll get specific numbers on the port volumes for Asiano tomorrow when they announce their March quarter port volumes. I think the prospect of the company delivering 15% EPS growth is probably a little stretched. I think it's probably going to come in somewhere around the 8 to 10% EPS growth. Puts the stock on a dividend yield of only around 2%, and I think relative to other opportunities in the market, there's more compelling investment opportunities to look at. Amcor trading at around 4.2% dividend yield on 13 numbers. On 14 numbers, that's pushing up to about 14.5%. The company should deliver at least 10% EPS growth. We're continuing to see positive commentary out of the company around cost control, synergy benefits still filtering through, and obviously the bolt-on acquisitions that the company has been making in emerging markets. All that needs to be put in the context also of global GDP not quite accelerating up to where a lot of analysts had expected, and therefore I think at around $10 it caps the upside, and our strategy's been to own Amcor at around this $9 level, which we've been buyers of it again over the past few months. and we're selling the $10 calls into the September dividend. They're a European style, so again, as a combination of that call premium, the dividend, we're getting roughly 10% cash flow out of Amcor, and we're allowing the opportunity for a capital growth there from around $9 up to $10 into that September period, which, if exercised, delivers sort of in excess of 20% on an annualized basis. So happy to continue to play Amcor on that basis, but at around $10, and again at sort of 4.5% dividend yield, the prospect of it sort of compressing down to sort of 3 or 3.5% and a rally up to $11 seems to be a bit of a stretch from the way that we look at things from a valuation standpoint. AMP, so value down here at $5, and in some of the client portfolios where we hold larger number of stocks, where we allocated small amounts of capital into AMP at these levels, but generally our base view here on AMP is that companies struggling to grow top-line revenue. Earnings growth came through fairly diligent cost control in the last half, and it really is a yield play from here, so yielding around 5 to 5.5%. And we see it as sort of a buy at around $5 and a sell at around $5.75, a European-style call option into the September period, collect the upcoming div, but expectation is for it to largely track sideways from here. ANZ obviously came out with their earnings result this week, so we had a 10% rise in first half cash profit to $3.2 billion, or just shy of $3.2 billion, and they increased their dividend 11%. From a recognition, I suppose, within the banks, again, loan growth is fairly muted. Cost control's been very strong. A lot of the uptick in profits coming through add-backs of bad loan provisioning that they've made in the past. That is a added performance or bottom line enhancement to the profit results is not going to continue forever. So from here we are considering we're getting down to sort of a 5 to 5.5% forward dividend yield, minimal top line revenue growth, still in the banks of probably only sort of 1 to 2% top line revenue growth. The market's certainly chasing yield at the moment. They're coming into their dividends in the month ahead, and a lot of capital's rotating into these names. There's certainly an argument that you're not getting, there's not a lot of risk that's being priced into these names at the moment. If there are any sort of shocks that come out of Europe or global GDP really not hitting the targets, then I think obviously the banks is where they're going to be some volatility. Resources are already certainly priced in. From a risk perspective, the resource names are already risk adjusted. But in saying all that, I think the view on the banks is that they largely sort of move sideways, and where we've had the opportunity, we've been rotating capital back into these names, but writing tight European covered calls to collect a small capital growth out of the asset, but predominantly the call premium and the dividends that we're looking at collecting in the months ahead. So from a valuation standpoint, comfortable with the banks in the context that we don't see a huge downside risk to equity valuations from here, but also mindful that we're not just yet seeing the loan growth or the revenue growth coming through these names. Again, a lot of the result coming through from cost control and from provision add-backs. ANZ made mention that they're looking to dual list on the Asian markets by 2017-2018, and that's obviously consistent with the group's endeavours to increase their exposure into Asia, albeit that they're getting more competitive forces coming through cheap capital flowing out of the US and out of Japan now, as an example, where we're seeing some of the international banks aggressively pursuing some of the opportunities within these Asian markets as well. So moving on from ANZ into ASX, so market volume starting to pick up a little. From ASX perspective, the stock's on just on about a 4.8% dividend yield. From a PE standpoint, and some of these PEs relative to what we would be used to, say 2 years ago, is a stark contrast. So going through whether it's Amcor trading at 17 times earnings, ANZ trading at sort of 12 times earnings, ASX now trading at 18 times earnings. But again, versus the sort of yield on offer in the bond market, where we've got companies that are delivering reasonably flat or mild sort of earnings growth, you were starting to see the dividends compress sort of even further. And I think we've certainly been buyers of ASX in client portfolios in our own internal portfolio on this pullback at around $35, and we've sold the 38.50 calls into September. So we're looking at collecting the upcoming dividend, and obviously happy to deliver the stock at around this 38.50 level, which again would lock in excess of sort of 20% return on an annualized basis there in ANZ. AZJ, to put some numbers on AZJ, we're largely of the view that top line revenue, so we're expecting underlying earnings to grow somewhere around 10% to 15% in AZJ. We've been buyers of it around this 380 level, and we've sold the 420 covered calls into around sort of the July-August period. So we've collected reasonable premium from those covered calls, and we'd certainly be happy to deliver the stock. We sort of see it really trading at the sort of top end of its valuation range and moving sideways, but one of these names that is well supported on a pullback. So happy to continue to add it to portfolios throughout the year on any pullback below $4.20. BHP, so when you look at the resource stocks from a valuation standpoint, BHP's yielding around 3.5%, trading about 11 times forward earnings, and should deliver somewhere in the order of around 10 to 15% EPS growth. We're comfortable that BHP presents value down at these levels. It may not be fully reflected until we get sort of 3 to 6 months out, but ultimately we don't see China slowing down much beyond sort of 7.5%. We see global GDP re-accelerating back up from sort of 3.5%, pushing up towards 4%, largely driven by stimulus, that unrelenting stimulus coming from the central banks. And I've spent a lot of time in prior recordings talking about the necessity for central banks to deliver asset price inflation in order to rebuild the growth in the economy and consumer confidence and so forth. Brambles trading up at around 18 times earnings. The story here for Brambles is that the company's reaffirmed earnings on a full year basis of just over $1 billion, so that'll sit within the target. The stock's trading on around a 3.5% forward dividend yield into 2014. Again, it's one of these names that we don't see a huge amount of upside potential from here, but we're recent buyers of it on a pullback at around this 825 level. We've sold calls up at around the 9 to 925 level into the September period. Again, it's delivering around a 10% cash flow from a combination of that call premium and the dividend yield. And we largely see the stock sort of bouncing sideways within this range, given that it is trading on a very high multiple. Company will deliver about 8 to 10% earnings growth, but the probability of them exceeding that is fairly limited. So we're seeing a little bit of positivity in the media with the prospect of Brambles spinning off the recall asset. We looked at that last year when the company was trying to divest it through a private equity sale, and that didn't happen. But there's certainly strong prospect that they spin off recall into a separate listed ASX company, in which case as a Brambles shareholder will obviously get access to that. But the story here is that the underlying pallet business is delivering reasonably defensive earnings stream. The stock's 3.5% dividend yield. The prospect of the recall spin-off, I think, supports the stock on any sell-off, which is really what we're looking for, with the index rallying as hard as it has over the last 9 months. It's about staying exposed to the equity market, but trying to strip the risk out of portfolios if we were to get a pullback in equity markets for some event that is not obvious at present. So Brambles is certainly a stock that we feel comfortable delivers that on a risk-reward basis. Moving on from Brambles, CBA. I'll come back to CBA towards the end of the presentation here. Coca-Cola. So we have Coca-Cola trading on a PE of around 19 times earnings, 18.7 times earnings. Certainly pushing up to 19 times, a div yield of around 4.2%. That's on 2013 numbers. On 2014, it's 4.5% dividend yield. The company should deliver about 5% earnings growth. Like Brambles, this is one of those names that we think the company will deliver its 5% earnings growth. The dividend yield's defensive. We've been buyers of it on the pullback here at around 14.40 in the last few weeks, and we've allowed the stock price to rally, and we've been selling calls at around the 15.50 level into that next dividend period. Happy to either deliver the stock ahead of the div, given that we collect a good premium for the call, or in the cases where we've sold the European call option, again delivering about 10% cash flow as a combination of the call premium and the div yield, plus allowing for capital growth from 14.50 to around 15.50. So again, one of these cornerstone investments in portfolios that we think gives up to a 20% annualized return without having that same downside volatility with the index at the levels that it's at present. Not doing that in CFX. Computershare. So I've just stepped in and started buying Computershare around this $9.50 level. We allowed the stock to rally a little, and we've sold the sort of 10.25 calls into the months ahead. Again, one of those names that we're happy to simply deliver the stock at 10.25. I think Computershare bounces sideways at or near this $10 price level. We're looking for 10% plus EPS growth in the 6 to 12 months ahead. CSL, the real driver here is the company conducting its share buyback. There's a substantial, roughly around sort of $400 or $500 million still to buy back between now and September. The stock on every measure is expensive from a valuation standpoint. It's yielding only 1.8% at present, trading on around 25 times earnings. Granted, the company's delivering above average earnings growth of around 20%, but we see that flattening out with the company going back to around sort of 10 to 15% EPS growth. So the price will remain strong into the conclusion of the share buyback, and later this year, if we were to see a pullback in CSL around the December period back to around $55, we'd consider that as a buying opportunity in CSL. Not doing there in Crown. It'll be interesting to see any commentary out of the company around the sort of gaming revenues from Macau. Not doing DX. Fortescue, we've largely exited Fortescue. We made a point of sort of cutting Rio, cutting Fortescue out of our model portfolio and across client accounts. Our preference has been to be weighted towards Woodside Petroleum and BHP because of the energy play. In the context that you consider what's happening to gold at the moment, I suppose go back 9 months ago and we saw what happened to iron ore, where iron ore was trading 160 a ton, pushed down to 85 US a ton around September, and then from say October through to January we saw iron ore recover from 85 a ton back up to 150 US dollars a ton. So the volatility in these commodity markets have been very substantial over the last 12 months, and I think to some extent I draw those sort of parallels with what's happening in gold at the moment, where there's been a real sort of squeeze of the weak hands out of the gold positions, and whilst I'm not a strong gold bull, I do think gold should find support and trade between that 14 to 16.50 US an ounce. So from Fortescue's standpoint, I think it's had a large part of its price adjustment. Iron ore prices are actually holding up reasonably well around 140 a ton. Again, I think most of the risk coming through from negativity around the prospect of a slowdown in China is largely priced in. You're buying Fortescue on a forward PE of it's subject to where you place iron ore spot prices. You're buying Fortescue on a forward PE of around 7 times earnings. So I think down at these levels it starts to look attractive, but again our preference is towards BHP and Woodside Petroleum. Goodman Group I'd always flagged as sort of one of the better property plays, but it's starting to get pretty expensive up at these levels. From a yield standpoint, the stock's getting down to around around about sort of 3.75%, which is extremely low for a property play. So I think it's starting to really sort of push up into an area where you're taking on a lot of risk. As is the case with GPT, again, it was probably our preferred property play. We were buyers of it at lower levels here, and we've largely taken profit up at around $4. So have GPT on a yield of around 4.6%. 4.7%, trading at around 15 times earnings. So I don't see a lot of downside risk to GPT, but with these property plays compressing down into yields of around sort of 4.5%, the argument for further upside diminishes a little. What we are seeing is share buybacks, add to the EPS earnings per share profile of the business, and providing some level of support. So certainly not concerned to the point that these names are going to fall in value, just mounting the argument we're certainly pushing up against the top end of valuation ranges if we're relying solely on the yield argument to keep driving share prices higher from here. IAG not doing there, nor in Iluka. IPL at the moment, so IPL reports their result, I think around the 13th of May, thereabouts. I think the result should go some way to appease some of the concerns in the market at the moment. I'm looking for IPL to trade back up to around 325. Obviously all the commodity stocks have been beaten up a little bit across the last number of months, but on a yield basis, IPL's trading at about 4.5%, trading on a 2014 PE of around 11 times earnings, and I think the stock provides reasonable value down at these levels. Leighton's not doing there at the moment. We've always sort of flagged that the structure for Leighton's may very well be changing in line with a view that global GDP re-accelerated on sort of a 5-year outlook. So we're yet to really see a structural higher-low formation build in Leighton's. The stock's yielding around 5% at these levels, trading at about 10 or 11 times earnings, so reasonable value, but the risks are diminishing around the transparency around its balance sheet, and we are seeing sort of positive commentary come through from the board in relation to that matter, flagging that kind of the worst is behind them from an asset write-down standpoint. So from a technical perspective, it's certainly worth watching Leighton's and see if we actually get a structural sort of higher low come in here that supports a higher low above sort of this $15 range. So keeping a close eye on it in the weeks and months ahead, but not setting new positions yet. Lendlease, on the other hand, we're buyers of this at around the $10 level. And around these levels, we're looking for the stock to push up a little bit higher to around $11, and then we'll look to set the calls at around the $11.50 level. But a good example there of where the stock created a good structural higher low. We see Leighton's delivering around 10%, 8 to 10% EPS growth. The stock's trading 10 times earnings on a 4.25% dividend yield at present. Our view is that sort of around $10 the stock's value, at around $11.50 it starts to get a little expensive, and it's one of those defensive names that we're happy to trade sideways over the remaining year on the basis that it bounces sort of within that range. Mirvac Group, we've taken profit on this, so we're owners of it at lower levels, and around this sort of $1.70 level we started to take profit and exit Mirvac. Just to put some numbers on that, the stock's delivering about a 5% dividend yield, trading about 10 times earnings, so certainly whilst not having quite the same growth profile, you can see the disparity in the valuations and the yield in comparison to Goodman and GPT that we looked at earlier. So Macquarie report their result this Friday. It'll be interesting to see. Obviously the mortgage side of the business will deliver some attractive sort of headline growth numbers. Whether that's enough to offset sort of some of the ongoing slowdown that I expect that they're experiencing in their investment banking and securities business, we'll have to wait and see. From a technical standpoint, I've just flagged here that the stock as a combination of the company doing a share buyback and better earnings growth, the stock's been well supported, but we're really not favouring Macquarie as an asset allocation until we sort of dig into Friday's results and form a view into next week's recording around that. National Australia Bank reports their results on the 13th of the 9th of May, I should say, for the first half 13 results. Probably out of all the banks, NAB probably has the least capacity to increase their dividend payout ratio. So my expectation is that, sort of given the reaction that and the repricing that NAB's had following the ANZ result, one would have to think again we're pushing up reasonably at the top end of the valuation range. We have been buyers of NAB at these levels for capital that's been freed up in portfolios and sold fairly tight European covered calls into the June period to collect the dividend coming up and to also capture some of that premium coming through from the call into June. So we've largely owned the stock at or near this sort of $32 to $33 level and sold the $33 European calls into that June period. But I think the story with all the banks is not that dissimilar. Limited top-line revenue growth, great cost control, profits being enhanced through provision add-backs, dividends being increased through increased payout ratios. So whilst on the surface the asset prices and the stock prices are performing very well, granted there's no major concerns in the underlying businesses, but the very positive headline numbers that are being printed in some ways are a result of sort of those adjustments that I'm talking about in the dividend payout ratios and in the provisional add-backs of bad loan provisions from prior years. So Newcrest Mining at a cost of production of around sort of $700 to $800 an ounce. If gold was to stabilise at around $1,450 to $1,650 an ounce, I think Newcrest is a good buying opportunity. The issue here has obviously been the company has had very poor production results. The market's lost confidence in the forecast from management. The latest forecast is for the company to deliver around 2 million ounces on an annualised basis. That's down from 2.5 million ounces, so essentially there's the 25% contraction in their production. What we're looking for now is management to deliver on their production guidance, gold price to stabilise around $1,450 to $1,650, and I think fair valuation for Newcrest is actually substantially higher than where it is, back up at around $25 to $26. Certainly there's been a lot of stop-loss type selling through margined positions into Newcrest, which is impacting sort of the selling pressure in the stock at the moment, and it really is a name that I think we have to come back and revisit in almost 6 or 12 months' time to see whether the fundamentals in fact sort of balance out and we see a valuation on the share price that reflects probably the underlying value of the assets of the business and the forward earnings outlook. News Corp, so the company's again under pressure to conclude their share buyback into sort of this June-July period. The share price should be well supported. The company should deliver about 10% EPS growth. So from News Corp's standpoint, happy to consider the asset at these levels, but I think from a risk-reward point of view, we'd prefer to be in your Amcors, your Coca-Colas, Brambles as our asset allocations at present. Origin Energy, so from a yield standpoint, Origin's delivering around sort of 4% dividend yield. It's on a PE of about 17 times, limited earnings growth into 2014, but expecting the company to re-accelerate EPS growth back up to sort of 10%. I think Origin can trade up to around sort of $13.50 towards the end of this year. So we're certainly not overweight Origin, but we have been buyers of it on these dips and really looking for the stock to move up to around $13.50 to either take profit on it or to sell calls. Orica at the moment, not doing there at present. Orica's trading at about 12 times earnings, delivering about a 4% dividend yield. Obviously, these mining services companies have had a substantial sort of readjustment in the PE valuations, where we're used to seeing Orica trading at around sort of 15, 16 times earnings. We're seeing that come back to 12 times earnings, limited earnings growth on a forward outlook. Not quite the environment to reconsider these names, but over the next sort of 3 to 5 months, we certainly may see Orica at a valuation point at maybe around sort of 10.5 to 11 times earnings, that we start to see a better environment where simply capital's rotated out of these names and created a valuation opportunity on a 6 or 12 month outlook. Oil Search has been one of our preferred oil and gas plays, and we've been buyers of it on the dip here of around $7. At around $7.75 we're sellers. We're getting around 20% for those calls, so it's knocking us out of the stock at around $8, and we've been buyers of it at lower levels. I think as Oil Search comes into the production phase in 2014 and beyond, the risk will start to come out of the stock, and fair valuation could be as high as sort of $8.50 to $9 on Oil Search. But right across the next sort of 3 to 6 months, we're buyers of it on a pullback at $7 and sellers up at around $8. Qantas not doing there at the moment. QBE, still some issues around insurance margins for QBE. And from a valuation standpoint, the stock's at 13 times earnings, trading on about a 3.5% dividend yield, but not an asset that we're preferring to allocate capital to at the moment. Rio, we've largely got out of Rio at higher levels. Our preference has been BHP and Woodside Petroleum. To put some valuation numbers around Rio, the stock's trading about 3% dividend yield and on a forward PE of around 10 times earnings. With iron ore holding up at around 140 a tonne, I think the earnings outlook for Rio is reasonably solid. I expect the company to deliver around about 8 to 10% EPS growth between 13 and 14. The prospect, I think, of the resource stocks finding support in the months ahead is quite good. I think the issue is that if the broader market largely bounces sideways, we may not get the strong rally in the resource stocks until we sort of get into the latter part of this year, or if we were to see excessive stimulus come through from the ECB. So I'm not seeing a catalyst in the immediate weeks ahead to see this rotation out of the yield names into the resource stocks, but I think certainly on a 6 to 12 month view that story's certainly still intact. Stocklands at the moment, to put some numbers on Stocklands, trading at around 18 times earnings, trading at about approximately say 5.8 to 6% dividend yield. We largely see it moving sort of sideways between this sort of $3.50 to $4 range, but not allocating capital to it in our internal account. Sonic Healthcare, we're comfortable from a risk-reward point of view that Sonic provides a reasonable opportunity. It's not a stock that allows for the selling of call options over it, so it really is just a matter of owning it at low price levels, collecting the 4% dividend yield, and trying to sell out of the stock at around sort of $14 on any rally. But again, from a risk-reward point of view, comfortable with Sonic delivering about 10% earnings growth. Santos at present, we'd owned Santos at lower levels, and we've sold calls at around the $13.50 level. So that's added to the dividend yield. The stock delivers around 2.5% through the call premium that we're getting there. We're collecting up to around sort of 8%, 9% cash flow on an annualized basis out of Santos. And from a valuation standpoint, the stock's trading at about 18 times forward earnings. We're seeing slight misses on the revenue and production side that's weighing on share price, but really sort of from this sort of $12 or $11.50 range through to around $13.50 is where we see it bouncing, and we'd be certainly happy to deliver the stock under that call at $13.50 in the months ahead. Suncorp not doing there at present. Sydney Airports not doing there right at the moment. Transurban, on the other hand, we've been strong buyers or allocators of capital into Transurban. We're buyers of it around this $6 level. Comes into paying its dividend next month. We're seeing reasonable traffic numbers come through from the both Sydney, Melbourne and the US toll assets that Transurban own. The stock's trading about a 5% dividend yield. Around here we see it fully valued. What you're seeing at the moment is what we've been forecasting or waiting for, which is we own the stock ahead of the dividend next month, with a view that obviously we'd see capital rush into the stock for the dividend, and we've taken the opportunity to sell the covered calls at around this 650 level to 675 level, and we're either happy to get called away and deliver the stock where we're making in excess of 20% return on the capital on an annualised basis, or if we don't, a combination of the call premium and the dividend gives us a cash flow in excess of 10% out of Transurban at present. Telstra at the moment pushing up towards sort of that 5.5% dividend yield. The stock, again, we're owners of it at this 450 level. We've sold European calls at around the 471 level, which knocks us out of the stock at around 490. So right at the moment, a push much above 490 we're not participating in. But certainly the stock price is performing strong at the moment. We're seeing just capital give up on the commodity space and really shift in towards these yield names at present. Toll Holdings, just starting to take another look at Toll at the moment. So the stock's trading at about a 4.5% dividend yield, around 13 times earnings. But from an earnings growth standpoint, we're not expecting much more than about 3 to 5% earnings growth in the 12 months ahead. So it really is a yield play at around 4.5%, and we've owned the stock at $5.50. We've sold the $6 calls. Again, one of those names that we're driving about 10% cash flow, and if we get the opportunity to deliver the stock at $6, happy to do so. Westpac result comes out on Friday along with Macquarie, so we'll watch that with interest. But to a large extent, where we've owned Westpac from lower levels, we've just started taking profit again at around this sort of $32 to $33 level for clients, where we've bought back into the stock at or near these sort of recent consolidation range through here. But on a forward outlook, with Westpac pushing up towards sort of a 5% dividend yield, or at the lower end of that range, the argument for further upside certainly diminishes. And again, the prospect of Westpac having an increase in their dividend, I think, seems reasonably slim. So the reaction across all the banking stocks following ANZ's result would sort of continue our view that the stock's just simply looking a little bit expensive, but well supported from yield, and in the context that the index is unlikely to face any significant selling pressure in the near term, the banks are probably going to bounce sideways from these levels. Westfield's increased their share buyback. So at the margin, I think at around 11.50 becomes the new support level for Westfield. From a valuation standpoint, the stock's yielding about 4.4%, trading at about 16 times earnings, and with limited earnings growth, probably somewhere in the order of 3 to 5%. In the absence of sort of the share buyback, best the price moves sideways. Given the additional buyback that the company is to be taking place, which in aggregate will mean that they've bought back 15% of the shares on issue at around 11.50, should provide reasonable support level for Westfield. Wesfarmers trading at about 20 times earnings. That's on 13 numbers, about 19 times earnings on 14 numbers. And again, if you put that in the context that Wesfarmers, if you go back a couple of years ago, was trading at around 14 times earnings. So that's really reflective of the compression in the yield from trading around 6.5% dividend yield, now down to around 4% dividend yield. The argument, the company will deliver somewhere around 10% earnings growth, but again, given that the yield at the moment is probably even on spot prices marginally below 4%, you would have to have a view that the stock's likely to largely move sideways. So our strategy here with Wesfarmers is to own it at these levels, but to go out and sell covered calls at around the 43.50 level into December, we're getting around $1.50 for those, so effectively knocking us out of the stock at around $45 and providing some protection to the downside through a combination of that call premium and the dividend. So driving a cash flow out of Wesfarmers of around 10% per annum, with a view that the asset just largely moves sideways. So I think the theme in the equity market is that at the moment is you're really having to pay a premium for defensive earnings and dividend stream, and I really think that's an environment where the covered call strategy can add value, because rather than going too far out the risk curve in the market, we can stay in these sort of lower volatility stocks, get the 10% cash flow from the dividends and the call premium, and simply trade the stock sort of within sort of that support and resistance range within sort of the top end of these value ranges that they're likely to consolidate in and deliver 20% annualized return where we get to deliver the stock under the call premium, 10% cash flow where the asset simply moves sideways within that band. So Wesfarmers, again, looking out to 2014, trading about a 4% dividend yield and trading about 19 times earnings into 2014. So a lot of the forward growth is already priced into the stock. Worley Parsons, a little bit like Orica, we're seeing these names under pressure at the moment. The company was guiding towards 5 to 10% earnings growth. We're probably not going to see that, and it's somewhere back down at around $20 in the next 2 to 3 months. Maybe we start to take another look at some of these names, but not quite at the moment. Woolworths, as with Wesfarmers, trading up at about 20 times earnings at the moment, and again, if you go back to, say, 18 months ago where the stock was trading 13 times earnings, at that point in time Woolworths was still growing at only 5% per annum. We come forward 12 months, the stock's now trading 20 times earnings. It's on a dividend yield of around 3.5%, and yet the company is not growing any earnings any quicker than what it was back here. So the shift in capital allocations in equity markets in the last 12 months have been some of the most excessive moves that I've seen have been involved in markets for some time across sort of these relatively stable asset prices, and it's really obviously a factor of or a function of global bond yields pushing down so low, and not just Australian investors but offshore yield funds coming into Australia with money that they're getting at next to 1% or less than 1%, and putting it into defensive assets that are delivering 3.5% dividend yield, so they can certainly justify owning these names. But there certainly comes a question as to how far this trade can be pushed before you're owning equities and not getting rewarded for the risk that you're taking on board, meaning that you can get 3% in the bank, you can own Woolworths, and you're earning 3.5%. So if the company has a cost blowout in their hardware strategy or lower margins, and we've seen the business margins compress from sort of 10% down to 5% from an earnings growth standpoint, there's not a lot of reward in there. So at some point you start to take a view that further upside appreciation, whilst potentially there short term, we will need to see some type of readjustment in the near future where these valuations, if nothing else, just simply move sideways. And again, if that occurs, or when that occurs, I think this covered call strategy really starts to add value again to some of these names where we owned them at lower levels. We made profit, but maybe in hindsight jumped out a little bit early. But I think in 12 to 24 months, we look back and the names will settle into a very long new consolidation phase where we'll certainly recapture any movement that we missed throughout this sharp correction to the upside through the added income that we get from the covered call strategy. So instead of holding Woolworths and collecting a 3% dividend yield, we'll be collecting 10.5% cash flow out of it. We're keen buyers of the stock on a pullback to around $33, $34. Let it run a little, sell the covered calls, and if we're able to deliver the stock at the top end of the valuation range, again it adds about 20% return to the strategy on an annualized basis. So happy to take a look at Woolworths again, and just waiting for it to sort of settle down and move into this consolidation range. Woodside Petroleum obviously announced their special dividend. This is one of the stocks where we're owners of it at lower levels, and we've sold covered calls at around this sort of $37 to $38 level. It was a European call, so we collected the special dividend this week of 52 cents, and we're happy to deliver the stock out in the next month or two at around this sort of $37.50 to $38 level. So we've seen this one of the first of the shift in the resource stocks, where Woodside Petroleum's increased their payout ratio to 80%. That's resulted in Woodside moving to a yield play of around 6%. Compare that again to some of the property plays that are down at 3.5%, Woolworths and Wesfarmers with the compression in their dividend yields. Obviously, there's a little more risk you're taking on with Woodside, but on balance, we bought into it at lower levels here, and we're happy to deliver it around $38 and reassess where we see the value of Woodside moving forward in the sort of second half of the year. Westfield Retail Trust, so one of the retail property trusts that we have been buyers of at around $3. We've been selling calls up at around this sort of $3.20 to $3.30 level, and I think the stock's reasonably well underpinned by the company share buyback. We've got it trading at around 16.5 times earnings, which is expensive for a property play, delivering a yield of around 5.5%. So again, buyers of it at $3, getting expensive up at these levels here. And there we go, and I'll just conclude tonight's presentation with a quick look at the XJO and just recapture where we see the valuations or the market moving in the months ahead. So traditionally, this sort of period from May through till September has been a weak period for markets, and consider that comment in the context of everything that I spoke about tonight from a valuation standpoint, a yield perspective, and where we see individual assets moving. The context, the global GDP hasn't quite reaccelerated like everyone expected. We're not seeing a huge amount of top-line revenue growth in the US. The Australian banks, yes, are delivering uptick in dividends, which is helping the share price. On the surface, the reported numbers are looking good, but we're not seeing a huge amount of loan growth, and we're not seeing a huge amount of top-line revenue growth. So this big adjustment in market, while some of it's coming from an improvement in earnings growth, a lot of it's being driven by money chasing yield, as I've spoken about. The only thing that's really going to ensure that global GDP does pick up and reaccelerate in the next 6 to 12 months, I think, is going to be a change of policy by the ECB and an improvement in the liquidity that they pump into the market. If we get that, then I think the equity markets could have another push higher, but always mindful of the fact that from a valuation standpoint, buying stocks 20 times earnings on 2014 numbers on a 3.5% dividend yield, there's not much protection on the downside if we get sort of negative news come through at a macro level. And for that reason, from an asset allocation standpoint in portfolio, we still think that this strategy of building earnings or building wealth generation in portfolios from the increased cash flow from call premiums over defensive stocks and having a bias towards those names in the portfolio delivered roughly around 14.5% average return for us on client accounts last year, and no reason why we shouldn't deliver similar returns in the 12 months ahead. And I think if you can continually deliver double-digit earnings growth in portfolios without taking on board extra risk in the long term, that should result in an ongoing sort of outperformance from a portfolio return perspective versus the index. Thank you for listening in to tonight's recording. I look forward to speaking again next week.